Stock and bond markets reversed their January gains as renewed inflation concerns drove yields higher and weighed on equities in February. Firmer than expected inflation has forced markets to end their expectation the Fed would cut rates in the second half of 2023. Instead, markets now expect the U.S. Central Bank to raise rates to as high as 5.5% over the summer. A 5.5% to 6% Fed funds rate more rightly prices the sticky inflation in the U.S. and closer to the 3 to 4% rise in prices we expect by year-end. Risk, we believe, is more pronounced in the euro area, where we see upside to even the 4% policy rate built into markets today. A 4 to 5% terminal rate in Europe would be more consistent with the inflation backdrop unfolding. In light of these shifting expectations, the resetting of bond yields back towards 4% in US dollar markets and approaching 3% in euro markets has brought the anticipated volatility highlighted last month. This volatility supported our hedge fund allocation in February. We expect this ongoing repricing of growth and inflation in the global economy will continue to support hedge fund allocations moving into the spring. The backup in yields has created an opportunity to add US dollar duration, especially should yields return to the 4 to 4.5% range of late 2022. Active bond selection remains important given tight credit spreads across the US dollar markets. For euro area bond investors, more caution is required, as upside risk to long-dated German yields remains significant. We now expect 10-year German yields could reach 3 to 3.5% by year-end, creating a headwind for bond investors in the single currency area. We retain our cautious stance on equities as the deteriorating earnings picture has now been rejoined by rising real interest rates on both sides of the Atlantic. Offering some hope, the sharp rebound in China's economy following its reopening has been confirmed by Chinese leading indicators, suggesting the next leg of China outperformance can come from improving earnings in the months ahead. Even with the rally in global equities, our preferred asset class, global fixed income, has kept pace over the past 3 months, continuing to offer investors better risk-adjusted returns as markets transition to a new regime. For more details on how we are navigating the return to volatility in markets in February, please visit us on ubp.com.